Hello and welcome to Closing Trades. This is Loan Studio, and the markets are hovering at a level which they're trying to maintain the 24,450 mark at this point in time. We briefly tested the 24,500, and then we have traced back there. And joining me in studio is Aisha Faridi and Kunal. Kunal, how do you look at the last half an hour of trade? We tested 24,500 and then we came off.
Yeah, we tested the 24,500 levels, and we've been hovering around those levels for the markets plus minus 50 points. I think that slight bit of edge of volatility is because of the expiry today and the kind of position built up which was seen. The put call ratio at yesterday's closing was almost at 1.5, 1.55 for the Nifty. That's cooled off to almost sub 1.5 levels, of course, for the markets. So that probably gives a sense that maybe some sort of an overbought zone on the indicators is what has kept the Nifty on check today. However, I think the market breadth is still on the slight positive side on a broader basis, because when you look at the kind of sector composition, there are fresh, strong revival signs of IT stocks making a good comeback. So I would sense that maybe it's a day of pause for the Nifty for the next couple of days, but the movement and the trend still remains on the upside.
I'm looking at the put call chart, and we were having a lot of put writing just before 1 o'clock, and suddenly after 1 o'clock there's an unwinding of puts which has happened, and the call writers have been aggressively pushing up the positions at 24,500. Do you think now 24,500 seems to be some resistance? Because in the morning you were of the opinion that we may be able to push through 24,500.
Yeah, it looks like, because, so I think today, for example, the reason why the markets took a bit of a pause and was unable to surpass the 24,500 mark at the start is because of, what happened to those individual large cap names like Trent, etc. There were almost 2-3 major large cap names which saw a bit of a knock, and that I think just about took the markets by a bit of a surprise, and you saw the index just about trying to consolidate. The other reason for that is, of course, the heightened put call ratio, which I think at one point had reached 1.5 levels. And we've seen historically that when PCR ratios cross 1.5, 1.6 mark, to break past about those ceiling becomes a bit of a challenge on that same day. And that's why I would believe that maybe after a day of pause, the index could probably channel back its momentum again and surpass those levels. So bullish on the indices and expecting the index to maybe, I think, closer to the 24,500 mark today. But more importantly, I think tomorrow onwards, I would expect the markets to gain a little bit more momentum.
Because the Nifty Bank is currently flat at this point in time. The only index which is outperforming is the Nifty IT, which is 2.7% higher. Do you think it's basically some bargain buying at lower levels for many of the IT companies?
Yeah, it's sort of, because I think the IT index has moved up to 1,000 points. We were almost at 26,000 on the Nifty IT index 3-4 days back, and now we are about the 28,000 mark for the Nifty IT index. And the major composition of the price movement has happened on the mix of large caps and mid caps. So we are not too much dependent on those 1 or 2 odd names on the IT stocks which are moving up high. In a normal scenario, if results would have been positive for individual stocks, you might have seen a 5%, 10% up move for individual names. But the fact that pre-result, these stocks are seeing a synchronized kind of a buying, where you're seeing large caps and mid caps all together, I think seeing a good upside. That generally indicates that this is more of a basket buying which is happening for the IT index. I think that should be taken as a positive stance. Now, hopefully, the result starts to be a little bit more better than what the market or the street anticipated. Then I think you might probably get a second leg of the uptrend for many of these IT names.
Now, hold on. We have Avi joining us with Stocks and News. Avi, what do you have?
So there are quite a lot of stocks that are buzzing in trade today, starting off from Info Edge, which is up by almost 10% on back of some very strong business update for this quarter. They've told that their standalone billings have increased by 15% on a yearly basis at 737 crore, and their segment-wise performance has also done very well, with Naukri up 17.5% at 552 crores and 99 acres also up 16% at 110 crores. Jeevan Sathi is also up by around 14%. So the strong business update is leading to some very strong buying in Info Edge. Up next is Cochin Shipyard, which is seeing some selling pressure on back of government government announcing a stake sale via OFS. They are raising around 1850 crore rupees by selling 5% stake, thereby reducing government stake from around 68% to down to around 62%. This is being done at around 1400 rupees per share, which is a 7% discount to the yesterday's closing price. Our next stock is RITES, which is buzzing in the trade and is seeing some very strong buying as it has received a letter of acceptance of its offer worth around 342 crore rupees for an international order to South Africa. This is for the supply and commissioning of diesel and electric locomotives and will be done in the next 20 months. Up next is Titan, which has come out with a very strong business update as well for this quarter, and the jewelry segment has outperformed the estimates by growing around 47% on a yearly basis, and so has the consumer segment. The watches have also doubled their estimates with a 23% increase on a yearly basis, and the eye care sector has also grown by 23%. Our last pick would be Trent, which has fallen and has seen some very strong selling pressure because of a weak business update. The overall revenue has come in below the estimates at around 5,666 crore rupees, which is slightly below what the street was estimating. So yes.
Thanks, Avi, for that. Stocks and news. Kunal, what about your picks?
I'll go with two buy calls. My expectation is that many of the mid-cap names would start to look a little bit more better. GMR Airports is something which I would recommend at the current juncture. The stock is on the verge of a breakout of its previous swing highs, about 115 marks. So, would look at a target of 125. Stop loss to be kept at 110. The second would be a buy on PNB Housing. Even this stock is on the verge of a double top kind of a breakout of the previous resistances around 1100, 1120 mark. So, would look at a target of 1155 for PNB Housing. Stop loss at 1085.
Okay. How do you look at some of the individual IT companies? LTI Mindtree, that's leading the pack in IT today.
So I think I would sense that many of these stocks are looking fairly attractive. L&T, Infotech, Mindtree, that stock has confirmed again a swing up move, a breakout. I think 4-5 days back, the stock was almost at 3,500 levels. Today, we've almost on the verge of breaking 3,900 marks. So it's a decent 10% plus recovery for LTI Mindtree. And I think on the short-term charts with today's candlestick pattern, one thing seems to be of very strong opinion that many of these IT stocks would probably have formed a near-term bottom for themselves, because the kind of candlestick pattern, a bullish pattern from the start, which you're seeing for many of these IT names, indicates that the base and the support which has been formed today should act as a strong support. So there's 36.75 should act as a decent support for LTI Mindtree, and on the upside, I would look at least 4,000 to 4,100 as a near-term target.
Okay, that's the take coming in on LTM. In the meantime, just taking stock of what else is happening in the markets. While, of course, Trent has been the biggest casualty today, and now the gap down in the stock has opened further as we now head into the last lap of today's trading session, and that stock is lower by about a good 11.5% as we speak right now. But, it's good to see that the trend in IT is not just restricted to large caps. While, of course, HCL Technologies is holding up 3.5%. Infosys is higher by 3.5%. TechM is looking very smart with a solid 3% of an uptick. Look at a Naukri right now. That surged almost 13% as we speak right now. That said, there's Persistent as well, which has charged along. So yesterday, after just a day's break, you've got the entire pack holding out well. 4% higher for Persistent, Emphasis higher by another 4% in trade. So across the sector, you are seeing extremely rejuvenated move, if I can call it that, and it's charging up ahead very, very smartly. Even TCS ahead of its numbers, it's holding up a good 2.5%. In fact, I'm going to quickly urge Darshita as well to join in and tell us what the ET Now poll is penciling in from TCS's performance, because, time and again, one has seen a similar trend play out wherein most of the IT trades turn out to be more of a buy on rumor, sell on news kind of a story. And post earnings, most of these stocks do actually tend to cool off. But Darshita joins in to tell us what we can expect from TCS's earnings. More importantly, what is it that we need to look out for from the commentary going forward about how much of the weakness is now in the price, to try and estimate that, and what really lies ahead for the IT bellwether. Darshita?
Right, TCS is expected to kick off the IT earnings season on July 9, and while the revenue is expected to remain broadly stable, the spotlight will be on the management commentary rather than the headline numbers. Street estimates suggest that the dollar revenue could remain largely flat sequentially at around $7.6 billion, while the rupee revenue is expected to rise nearly 2% QOQ, aided by currency tailwinds. However, the profitability is likely to come under pressure. EBIT margin is estimated at around 23.9%, which is down 141 basis points sequentially, largely due to the annual wage hikes. Now, if the margins come in around these levels, it would mark TCS' weakest first quarter margin in nearly 11 quarters post Q1 FY24. Also, the PAT is expected to decline by about 3% sequentially. Now, beyond the numbers, the investors will closely track whether management optimism on FY27 is beginning to reflect in the business performance. Constant currency revenue growth is expected to be in the range of flat to 0.3%, suggesting demand remains stable but not yet robust. Another key metric will be total contract value, which is expected to come in around $9 billion to $11 billion. Now, a strong deal pipeline would reinforce the confidence in the medium-term growth outlook. Management commentary on the macro environment, particularly in the BFSI segment, discretionary spending trends and international demand will be critical. Investors will also watch for updates on the TCS AI business after the company reported the AI revenue run rate of $2.3 billion in the last quarter. While the wage hikes are expected to weigh on the margins this quarter, continued investments into the AI capabilities and AI-led pricing pressure remain the additional headwind. So overall, this quarter is less about the headline earnings and more whether the early signs of the FY27 recovery stage are beginning to engage.
Yeah, exactly. The market, I think, is going to be watching with hawk eyes on what the commentary of the management is and how much of a revival do they actually see from the next quarter onwards. But we'll continue tracking those trends and many others, but on the other side of this very quick break. Back to closing trades right here on ET now. And the closing trades are looking quite comfortable, while at an index level, we've not really moved so much in percentage terms. But to think of it, we're at that 24,500 mark, and that's near about 8.5% recovery that we've seen on the Nifty alone from those March lows. Well, today, the pressure points continue to be Trend, L&T, there's a Reliance, ICICI Bank, BEL, which are not participating in today's move. But look at technology. That's really come to the fore across the market cap categories. Bajaj Finance has been holding strong. There's Swiggy, there's Eternal, there's the JSW Steel, Bharti, as well as Maruti, which are all holding up in the green. And today you're seeing a minuscule move from HDFC Bank and Axis, much unlike yesterday, wherein Axis was actually a rank underperformer and HDFC Bank one of the key performers on the index. So that's looking good. And yes, the breadth of the market is tilted towards declines. I mean, look at the quantum of losses, for instance, on a Trend that's down 12% right now. Kalyan Jewellers is down 7%. MCX is lower by 3.6%. And then BSE as well, which is down about 3.25% as we speak. But what's the way forward for the equity markets? We've got Jyoti Vardhan Jaipuria joining in on the show to answer exactly that. Jyoti, great to have you on ET Night today.
Hi.
Thank you so much for your time. You know, we were just discussing earlier today that from March lows, it's been a fabulous recovery that's already taken place. And now you've got the comfort factors coming in on crude as well, which is sizably lower from where we were during March period. What next, Jyoti, in terms of a trigger for the market?
Yeah, so, I guess from March, when we look at it, we obviously have to think that March was a very bad month, and to that extent, a lot of recovery, which you've seen, correcting the March loss. But I think the big move has been really, if you've seen the small caps, not so much in the large caps as in the small and mid cap. The small cap index is up, I think, 20 odd percent, and the mid cap is also up, high double digits. So we've seen that recovery. I think, from our point of view, that 2-3 things which continue to be positive. One is, I think earnings will recover. So we've had 2 years where earnings have grown at 5%. And, this year, I think we'll get earnings growth in double digit. Next year also will be double digit. I think next 2 years, probably instead of 5%, we are going to see earnings grow at around 15%. The second is, as you said, oil. Oil coming back has restored our macro. Because, in March, everybody was worried about the macro stability. and that part is again behind us with oil at this level.
Always.
The current.
Well, we seem to be on a very patchy line with Jyoti. Blame it on the Mumbai rains. We'll pick up on that conversation going forward as well. Kunal, do you sense that small caps and mid caps will continue to outperform the benchmarks going forward as well? Or is there a case now of perhaps large caps doing better in the next lap?
No, I think it should be synchronized. I think it should be mid caps and small caps trying to show signs of outperformance. So, what happens is that the last 800 points or the 1,000 points of the Nifty is where the market sentiment has become a little better. However, we've still not gone to that strong risk on appetite mode for the indices. That generally happens once we break past about crucial resistances for the index. Say, for example, 24,500 being one of the critical resistance or the mark for the index, but the bigger breakout could be at 25,000 mark. Once we break past about these strong psychological levels, is where the risk on appetite comes back, and that's why you see heightened activity. To start to look out for more of alpha generation, and in that scenario, I think the mid caps and the small caps they tend to outperform. So I think for someone who's looking at building a short-term trading portfolio, if being bullish on indices and expecting a breakout of the 25,000 mark, then I think the mid caps and small caps will stand to outperform.
Now, Kunal, what Jyoti was also mentioning, the small cap has gone up by nearly 21% in the last 3 months, the mid cap by 14%, and the Nifty 550 by only 5.5%. That kind of outperformance which we have seen in small cap, is that also because the kind of fall was also extreme for small cap?
Yeah, because the sell-off was very extreme. So, you look at the correction for many small cap and mid cap names from the 2024 highs. An average correction was around 30 to 40% for many of the small cap and mid cap names in the past 2 years or 1.5 odd year approximately. Now, in that time span, when you look at the indices also, the indices went through a very sharp phase of correction. Now, in the phase of recovery, it's because these stocks were sold off significantly on the much steeper side, on the downside, is where you've seen these stocks as well as the small caps and mid caps seeing a very sharp bounce back. And that's one of the major reasons why you've seen the mid caps and small cap indices hitting hitting the respective multi-month, multi-quarter highs much prior to the benchmark indices. Case in point, one more index which has also come back closer to its multi-month high is the Nifty Next 50. So you look at the other set of large cap names, the tier 2 large cap stocks. Even that index has come back into a good 20% recovery from its previous lows of 60,000 approximately. So that tells you that the market construct has been more towards mid caps, small caps, and the tier 2 large cap names, and that's where I think the tilt should continue.
Okay, Jyoti Vardhan Jaipuria is back with us. Jyoti, apologies for that bad connection. Perhaps it's because of the rains. But yes, you were telling us what triggers is the market going to be looking out for going forward?
Yes, I'm not sure where we got cut off. So one is the earnings recovery, which I think over the next 2 years would be more like 15% from the 5% we've seen recently. Second is if you look at the macros, in March, there were a lot of worries about the current account deficit and then the currency weakened as a result of that. With oil having come down, the macro worries now are easing off and macros starting to look good. Especially now, once they get the FCNR coming through also, that will start boosting up Forex reserves also. And third is, the FIIs have been big sellers in the market. If you see, they've been crazy sellers. I was in, US and then in Hong Kong a couple of weeks ago. So in general, most people are underweight India. So, there's a positive and negative to it. The way I'm looking at it is it's a contrarian indicator. Most people have given up on India now. I think the immediate trigger for them will be not so much the earnings recovering as much that there is a worry on the AI stocks, there's a worry on the chip stocks in South Korea. And, to that extent, people may say, okay, let's cut down India's underweight a bit. India is today the largest underweight it's ever been in the last 25 years for FIIs. So to that extent, there's extreme positioning away from India. And I think we'll probably see some of that getting reversed. I don't think we'll have, they're getting overweight, but at the same time, probably people will want to cut their underweight a bit. And that may mean that FII outflows will be lower than what we've seen over the last 6-8 months.
So you play the India India basket through financials, or are there any other sectors that you are also looking?
So, we play a mix. So we like financials. It's, one of the important sectors which we like. The other thing which we like in a big way is the pharmaceutical and the healthcare space. So that is again something which we are usually overweight with. The third thing which we are playing is, a broad mix of auto ancillaries and capital goods, which, generally I club under one as, the manufacturing setup. What we are underweight on in a big way is still IT, and that continues to be underweight. And the other thing is the consumer staple space.
Is there a specific pocket within pharma? Means only the export side you're looking at, or CDMO side as well you're looking at, or specialty chemicals in the chemical space?
So, in pharma, there are two things which we are overweight on. One is the CDMO, which you said, where, we love the space over the next 5 years. Valuations are what concerns us, but we still have some exposure there. The other thing which we have a much larger exposure on is actually the generic pharma. So if you see generic pharma for the last many years, generic prices kept coming down. And so generic pharma didn't really perform. We called like the bottom of generic pharma 18 months ago, and that's where we gone hugely overweight on generic pharma companies. And our sense is the next 2 years will still continue to be broadly very, very good for this. So, that's like a important space for us. Chemicals is something which actually we were not having an exposure to, but we have actually started buying now. And there are two reasons for it. So one is, stock prices have come down quite a bit. So they're not cheap still, but, at least they've become better valuation. Second is, our sense is earnings will pick up for them in a big way. So, in the first quarter, there was high freight costs, high insurance costs, which were hurting them. China, on its part, actually is probably going to behave a little more sensibly on prices, because what they've done is remove the export incentives which were there from April of this year. So now, that competition from China, which at some point seemed unreal, is probably not going to be there. And because of that, I think margins for a lot of these chemical companies can start picking up.
Okay, that's the take coming in pharma. In the meantime, just looking at the big strength sector today, and that's clearly IT all the way. Kunal, I just want you to come in here because, today the strength is not restricted to the large cap names, but look at a Naukri, for instance, a quasi-IT, stock in that sense. And then, Persistent, Emphasis, the mid-cap IT end of the market. Any trading opportunities here?
Yeah, quite a few. In fact, Persistent is something which starts to look very attractive at the current levels. Even after this, 3%, 4% up move for the stock at the current juncture, I think, the stock is also on the verge of a flag pattern breakout above 4,900 mark. So maybe if once that level gets taken out, you might probably expect the stock to start to move into a trending manner in the short term. Levels of 5,100, 5,200, they start to open up for Persistent from the current juncture. Coforge is on the verge of a triple top breakout. Also, I think if I'm not wrong, the stock is also on the verge of or very, very close towards its 200 moving average for Coforge. So that's another name to watch out for, because once that breakout happens, both a triple top as well as a 200 DMA breakout, the stock could surprise with a decent 300 to 200 point on the upside. So which means that we could be looking at a point where many of these stocks could be at the cusp of at least another 5% to 7% swing upside.
Okay. Jyoti, curious to know what's your take on IT, because we've seen these kind of moves many a times earlier, only to clock in fresh lows. What's the expectation in terms of what the commentary going forward could be from the IT majors when they declare their earnings starting this week?
Yeah, so, we've been zero weight on IT for 3 years now, because, we had got this AI a little early, more because of some of the international people we deal with and, what they had explained to us. It's getting a little attractive in just two respects. One is, now consensus is worried about AI trade. And so to some extent is there in the price. Second is, stock prices have underperformed a long time so that it's become cheaper. But we still, for us, it would be more like maybe there's a trading opportunity at some point. But otherwise, the growth rate of these IT companies are still going to be much slower than what we've seen in the past. So I guess, when the commentary comes, people will say that they're seeing things improving a bit, but, the environment still remains uncertain for them, just given, the way AI is taking over and the developments there. So I don't think, any IT company will give a guidance which is like super bullish or something.
Jyoti, curious to know how you're reading into the quarterly updates of the entire consumption basket so far. And I'm not just talking about staples, but some of the niche urban consumption plays, the retailers, for instance, the BPC segment. Any trend that you're witnessing here, which could be a good investable anecdote?
So, to me, actually, the trend has not been so bad. It's, been fairly okay. The problem has been with a lot of these names, expectations were very high. So when you look at what they're announcing with expectation, any small misses and the stock prices fall quite a bit. So, you see it with whether it's the retail name or the jewelry name and all. Once you get like any misses relative to a high expectation, they tend to fall quite a bit. But even if you see the staple names, they have been showing growth. It's just that whether, the growth continues because of the monsoons remain edgy and then, it's not a great agriculture season, then maybe this won't play out. And second is, like I said, just the valuations. Even if these growth rate comes at those valuations, can you really make money? Because from our point of view, when we look at risk reward, the staple space especially just offers no risk reward.
Do you think that markets don't have enough patience now? A slight disappointment and it gets punished very badly, like a trend is getting done today, or for that matter, a Kalyan?
Yes, some of these are not cheap stocks. The problem is when the stocks are not cheap, and you saw the same thing happen with, the power equipment people a couple of days ago when, Chinese players were allowed in. Because, these things, people believe that there's a very high growth rate, which, we also agree the growth rate is high. But the valuations are such that the margin for error in valuation is very low. So every time you think there's some negative news, and if suppose somebody's supposed to grow at, let's say, 25%, he grows at only 20%, then people say, okay, then I need to mark down valuation from 25 to 20. And that's the reason share prices tend to fall quite a bit.
And if you look at within the financial space, which are the segments which you like? Is it the private sector banks or public sector banks or NBFC? And if you want to just break it up more, capital goods as a theme, do you look at that as well?
So, within the banks and the BFSI space, at the moment, we are more overweight on private sector banks, but not the larger private sector, but the smaller private sector banks. We are also started to build positions in the NBFCs. So probably we believe over the next couple of months, we'll probably be overweight on NBFC than we are today. And the logic for a lot of this is just, we see NIMs come under pressure, and that NIMs are probably going to start expanding over the next 1 year as your deposit interest rates start to get repriced down. Within capital goods, it's like a very large sector. We are always hunting for two things. One is, we want growth visibility. And second is we want valuations to be a little more reasonable. So we have exposure, I would say, to the water space, which is, something which has done very well for us. And then we have exposure to the pipe space.
Okay, makes sense. Jyoti, any other overweights in the market other than the sectors we just discussed?
So, from our point of view, these are like the bulk of the sectors which we have. So, I think of like consumer discretionary as probably one, technically it's not a sector, but, when we do our portfolio analysis, we think of consumer discretionary as one space where we are a bit of overweight. So here, we have like autos, which is one of our favorite things here. So a lot of it, we are playing through the auto ancillary space because, a lot of ancillaries cater to different auto majors. And to that extent, which of them gains market share does not matter to the auto ancillary as long as the whole segment grows. Second, a lot of the auto ancillaries, because they are into engineering, they are also, starting to cater to to the defense space, to this space, that space. And you get it much cheaper than what you get, the more well-known defense companies. So auto ancillaries is one space which we find very good visibility on growth at reasonable valuations.
Jyoti, capital markets as a theme, you have SBI Mutual Fund coming out with an IPO maybe early next week, which is there. How do you look at AMCs as a whole?
So, in general, the capital market theme is very interesting because, capital markets will grow over the next 5 years. And a lot of these, the operating leverage is very high because, there are a lot of fixed costs there. So as, the top line grows is good. for us, it's probably given the way markets have behaved over the last 1-2 years. These are stories which do very well when the market is going up. When the market is flattish, then you probably start to see, some sort of consolidation happening. So at the moment, there was a point where we were very overweight a lot of these names. At the moment, we are not very overweight. We are more into the banking space and the lending space.
Thank you very much for joining us, as always. Thank you. Moving on to another stock which is buzzing in today's trade is Swiggy, which is up nearly 6%. Sneh is joining us with the reasons.
Well, yes, so Swiggy is in focus and doing well in trade because we've got an update from the management that the foreign holding in the company has now reached 49.76%. It has come below that 50% mark, and this is as of July 6, which is yesterday. Now, this automatically means that this is as a part of its ongoing efforts to qualify as an IOCC, which is an Indian owned and controlled company. Now, foreign holding includes FPI, FDI and indirect foreign investments, and all of them have been capped below that 50% mark. But the company has clarified that just basis this development, there is no change in ownership, control or management as of yet, and there is no impact on operations, voting or shareholder rights. Why this is such an important news for the company, and why is the stock reacting so positively to this? Because remember, in the second half of May this year, the company had expressed its desire to become an IOCC. They had floated a proposal to the shareholders, but that IOCC proposal was rejected because shareholders were worried about too much concentration of internal board power at the top. So now Swiggy has crossed one of the hurdles on its way to become an IOCC. This development does not automatically mean that the company has become an IOCC just because the foreign holding has been capped under 50%. The shareholder nod is still required, and a proposal for that will be floated out soon. The advantage of Swiggy becoming an IOCC is they gain ownership around their inventory, warehousing structures become cheaper, sourcing becomes better for them, margins improve, and this could materially improve the profitability of Instamart. While this is one reason, the entire separate other reason is because IIFL Capital met with this management of Swiggy, wherein they say that Swiggy is prioritizing high quality customers over aggressive discounting. They're aiming for stronger unit economics. The line that the street has liked the most from that commentary is they are very sure that Instamart's contribution margin will break even in Q1, which is this quarter. This was a big question mark that the street had, and the management has answered that. So we'll be watching out for the numbers when they come out for this earnings season. They also say that most of the dark store expansion is behind them. So on the back of both of these developments, the stock of Swiggy is soaring in trade.
Sneh, hang in there. Trend is under severe pressure after missing street estimates for the first quarter. Revenue grew slower than expected, and Zudio saw stronger store additions. Sneh, what is the update that you have there?
Yes, absolutely. Before we take a look at brokerages, just want to sum up the kind of Q1 update that Trend has given. Revenue has grown slower than what the street was estimating. It's grown at about 18.5%. Street was estimating 22 to 25%, so slow over there. While Zudio growth has been good, you have West Side store addition that has only been one, and that is something that the street has not liked. On the back of this, here are some brokerage reactions. Motilal Oswal has maintained its buy rating but hiked the target price to 3,785 from 3,500 now. So looking to buy this dip. They see this dip as a positive move. The UBS note says that they've maintained their buy rating with a target price of 3,633 rupees. They believe Macquarie has maintained outperform with a target price of 3,600. Bernstein maintains outperform. We spoke with them earlier in the day. They have not changed their estimates as well as target price of 3,500. Morgan Stanley has maintained an overweight rating with a target price of 3,151. They believe Q1 standalone EBITDA margin will improve by 100 bips to 18.5%. But they're also flagging off that they could see some weakness in near term given the slightly weaker print. We also have a note coming in from Citi wherein they continue to maintain a sell rating, target price at 1,822. So that's significantly lower to where the stock is, and this is perhaps the most bearish note that we've seen from a brokerage house on Trend. And lastly, we've also got word from Goldman Sachs wherein they've maintained their neutral rating, target price at 2,886 rupees per share. They say that marginal deterioration in trends for sales per store is something that the street has not liked, but Q1 like-for-like growth will likely be in low single digits, and they maintain their FY27 and FY28 growth estimates, provided the downside risk for like-for-like growth does not recover to mid to high single digits. So that's a risk that they are penciling in, and this is basis the recovery in like-for-like growth that they are penciling in their estimates on. But yes, largely this is the brokerage reaction that we've got on trend. Despite the weakness, we've not seen any major action coming in from brokerages, so seems like they're waiting for the Q1 earnings to come out before making any changes.
Absolutely, two polar ends in the market today. One, of course, is Trent and the other one is Swiggy. But on that note, let's take a very quick break. We'll come right back, continue tracking markets on the other side. Back with closing trades right here in 18 now. We're holding steady. We're circling around the 24,500 print for the Nifty futures. IT, of course, is the big winner today. Other than that, Titan, Eternal, Bajaj Finance, HDFC Life, these are the other movers in trade. And yes, Axis has recovered somewhat after yesterday's downtick, while the breadth of the market continues to tilt in favor of the laggards. And today, there's MCX, BSE, even Biocon and Laurus Labs have joined the losers list. Both these stocks are down currently by about 3 to about 4% apiece as we speak right now. But let's also welcome on board Devash Vakil from HDFC Securities and chat about what he's feeling in the markets right now. Devash, hi, afternoon. Good to have you on the show. Devash can't help but notice the move on IT, renewed vigor, but will it sustain post TCS's performance? What are you anticipating from at least the frontline IT names this quarter in terms of a commentary?
Right. So actually the quarterly result numbers which are going to come out now, most of the companies are likely to come out with decent numbers. The expectation on the street was quite muted. And I think on that front, we expect IT companies to surprise on the top line on the in this quarter. Though FY27, the overall growth is going to be muted, but we feel that this results may spur a bit of buying from institutional investors. We have been quite underweight on IT in our model portfolios, and a few days to few weeks back, I think gradually we have started investors to equal weight IT, because I think the correction was overdone. There is opportunity. We feel that there is a likely move for next 3 to 6 months around single digit to mid double digit returns can be there in the large IT companies. If you are looking for alpha, I think small and mid cap IT companies do offer a lot of opportunities, and that's where for our investors we have come out with ideas in the mid cap and small cap space also. So overall, we were quite negative on IT, but now going forward, they have come down to an attractive level, and there is stock specific opportunity available in this sector.
So Devash, within the IT, do you prefer to look at the persistence and Coforge kind of companies or the large cap ones?
So large caps aren't likely to give that kind of return, but mid caps is where we will find a lot of opportunities. Our institutional research has put a buy on companies like Mastech, Sonata, Birla, Soft, Zensa. These are the ones where there are decent upside from here.
Devash was just looking at some of those consumption plays and the quarterly updates from there. Tell me, how is it that you've read into the likes of a Dabur, Marico, and the strength that they've posted, as opposed to what some of the retail plays across segment, be it the likes of a Trent or for that matter Titan, etc., have delivered? I know not an apple to apple comparison, but just the larger consumption umbrella.
I think still there we need to be overall a little cautious. Though western part of India has seen a lot of rains, but overall net still we are worried about overall precipitation in the country, and especially on the northern side. So we need to watch out for what kind of impact it has on the rural demand, and that will determine whether we'll continue to like the FMC. So again, the updates are a little better than what markets were expecting, but I don't think we should straight away allocate capital there. some stocks like Godrej Consumer, where we have coverage and where we have a buy rating because of their international exposure. Similarly, for a little bit of Dabur, but other than that, it's purely local FMCG companies. I will wait for clarity on the monsoon front before taking an exposure.
Devash, how do you look at the capital markets play? Today we are seeing BSE and MCX on a weak footing today.
Recent RBI regulation make sure that the proprietary traders may not be able to fund their positions the way it were earlier, and that has created impact on certain bit of BSE and MCX, and that's why we are seeing the volumes coming down there. There are also competition from NSE coming into the market as it gets listed, and I think investors who had exposure to these stocks are creating liquidity in anticipation of large IPO. So I would be overall longer term financialization of savings, and especially these capital market plays are a long term play. But tactically for next 3 months, I think it will be better to wait for NSE IPOs before committing capital.
Shivangi, wanted to get your take in on the charts of BSE and MCX, both those stocks under pressure today, and whether you see any continued downtick. Shivangi, you'll have to unmute yourself.
Looking at the entire capital market stock space, we're seeing that on the larger time frame, on the weekly basis, there is still kind of hope, and the support levels are being respected intact on the larger time frame. But immediate basis, there is some bit of pressure from the last 3 odd weeks. Now, looking at a portfolio perspective, these are no problem stocks and should definitely be carried over. But trading perspective, one could look at BSE stabilizing near around about 3,700 and recovering to those levels to again start buying and play the negation trade.
What's your take in some of the retail companies? So today Trent has been hit badly. How do you look at V-Mart or V2 Retail? V-Mart and V2 Retail.
The entire retail space, if we look at that, V-Mart is technically actually sounding quite stable as compared to the other names, and it's holding on to the higher levels as well. This could definitely be kept on radar. Now, this is kind of getting ready for a good up move after a slight bit of consolidation, but this could head up to 820 odd levels.
And V2 Retail?
So out of the two, of course, V-Mart is a better placed stock right now technically. So this is the take on this entire space.
Right. Okay, Shivangi, we'll let you go on that note. Thanks as always for taking the time out and joining in. But Sajid, over to you for what the F&O markets are indicating and what the internals are looking like.
Yeah, means we've seen the volatility coming back to the market in the last half hour with the Nifty just slipping into red. It's hovering around the 24,400 odd mark. Actually, in the morning we saw, briefly testing the 24,500 before we saw a good amount of call writing coming in after 1 o'clock, as a result of which we saw the market slip there. But at this point in time, the Nifty is down absolutely flat in the negative territory. The shorts got covered in the morning, so the open interest is down nearly 1.18%. If you look at the Nifty Bank again, the Nifty Bank is also absolutely flat in today's trade. This a minor open interest increase there of 0.4% there. But look at what's happening in the constituents of Nifty Bank. You will get to see that stocks which were adding long positions in the morning, like ICICI Bank or SGFC or SBI, which show some short covering, are currently adding short positions. So there's some shorts getting added to the banking space today. Axis and IndusInd are the only two banks aside of AU Small Finance where we are seeing some long positions getting added. Call and put writing, it's aggressively happening at 24,500, with the call writers at this point having a better say on the resistance for the market there. Look at the distribution chart, and you will see that during the day we've seen the put writers, almost overtaking the call writers at that strike 24,500. But now again, it's they are on the pole position and preventing the market to go up there. So 24,400 is something which is holding on as of now. The futures gainers, if you look at it, you will see that Info Edge, Swiggy and Havells are seeing some long build up. Info Edge is up nearly 13%, Swiggy 7% and Havells 3.8%. Among the losers, you have Trent, one of the stocks, down nearly 12%. Further sell-off, selling pressures coming in Trent in the last half an hour. Kalyan is down 7% and Biocon is down 3.7%. Open interest gainers include stocks like Trent, where 34% jump in open interest is seen. Short build-up seeing Cochin Shipyard, OFS in progress, seeing an open interest build-up of 22%, and PB Fintech long build-up happening, 13% jump in open interest there. Among the losers, you have stocks like Hero Moto, where there's a short covering happening. Oberoi is seeing a long unwind, and Persistent is seeing a short covering. So pretty much in the IT pack, you're seeing a lot of shorts getting covered in today's trade there. But the most active, which suddenly spurred up, is TCS 2100 Joule call ahead of its earnings on Thursday. There's a premium of nearly 14 rupees. There's 1.15 lakh contracts getting added there, and stock holding up at 2090, with the 2100 strike being the most active for the call. And in the put side, you have Trent, which is very active, especially the 3000 July put strike, where the open interest is up nearly 2.74 lakh contracts and the premium of 108.6. So a huge volatility happening in Trent in terms of the premium. The premium currently at 136, and the stock holding off just below the 3000 mark there. And the market currently trying to hold on to 24,400 levels at this point in time is down nearly 1.12%.
Oh yeah, absolutely. So some amount of volatility creeping in, but the sectoral composition for the market pretty much remains the same. And even with this volatility, we are just about stuck in a very, very narrow band. But let's get you an ET Now exclusive. And ACMA is now seeing a 9 to 10% growth for the industry in FY27. In fact, speaking with ET Now, the president mentions that he is seeing growth in the US markets and its implications on the Indian players. Hear it out.
To this year, the first quarter, what I've been reading and what I've been understanding, first quarter numbers also stay solid. So we are hoping that this whole performance continues into this year. We grew at 12.7%. I don't know if we'll grow at 12.7%, but we will grow either in the late single digit or early double digit numbers, I'm hoping. I'm also hoping that the West Asia crisis settles down. And then there are a number of whole FTAs, BTAs that are in the offing in the next, one comes into effect next week, and then the EU and the US over the next few months. So that will add to our export ability. So overall, I am very positive about what the industry is doing, and I'm certainly hoping that we'll be able to continue with this solid performance.
Talking about the numbers, so after 2 years of surplus, now this year you face like 1.3 billion of trade deficit. So what was the reason behind that?
So a couple of things in my mind. As the industry is transitioning to newer technologies, as we look at the vehicles that you and I drive, what was there in luxury vehicles is now coming down to early entry-level, mid-level vehicles. Let's say the screen in front of us, or a sunroof, or ventilation technology. A whole bunch of new technologies are coming in. Some of them, and this transition to EV, some of them are still competitive in some other parts of the world because the volumes are large. Plus, there are some advanced technologies in other parts of the world. As this transitions into India, as volumes go up, as we start localizing these technologies, and as we start absorbing these technologies, and we start building a base here, I think India will start producing. India started producing this and will continue to produce more and more of these technologies as we go forward. So hopefully over time, our own Atmanirbharta will increase, and our own localization content will increase, hopefully taking the pressure off the import side.
That was the ACMA chairman talking to ET now. But Devash, how do you play the auto pack? Are you going to do through the OEMs or the auto ancillary?
OEMs do offer opportunity, and for auto ancillaries, I think the mid-cap and small-cap stocks there also are giving good opportunity. In fact, the whole BFSI banking, which is rate sensitive, auto and real estate, I think these are the three sectors which are going to lead the markets higher from here. See, after the monetary policy, we have come to a conclusion that because of the policies by government and MPC of RBI, cost of capital is headed lower in this country. We have already seen a good response from FCNRB deposits. So that means if capital is going to be there, rate sensitives will perform, and they have been quite consolidating. They have not performed. So there is an opportunity for investors, our viewers, to allocate higher capital towards BFSI space, large banks, private and public sector banks, auto companies, and real estate large caps. I think these are the areas post quarterly result and over the next few quarters. These are the ones which are going to give us alpha.
Okay, Devash, stay with us. Some more news coming in from Adani Enterprises, which has now achieved a major global milestone in its metals business. Its subsidiary, that's Kutch Copper, has received LME registration for its Adani Copper Grade A cathodes, putting the brand among the world's recognized copper producers. In fact, the approval allows Adani Copper cathodes to be now delivered against LME copper future contracts with warrants eligible for issuance come July 10th. In fact, this recognition validates Kutch Copper's manufacturing quality and responsible sourcing. Its Mundra facility has a production capacity of 0.5 million tons annually, and the milestone is expected to reduce India's reliance on imported refined copper while strengthening the country's position in the global copper supply chain. In fact, that is the comment coming in from Vinay Prakash, the MD at Kutch Copper, as well on the LME recognition. In the meantime, just want to take stock of metals because that's been a volatile piece of late. And Kunal, since last week, that metals rally seems to have paused a little bit. Today, most of these names once again in the red. What trend do you foresee now for metal stocks?
Yeah, they are into that process for a bounce back, or at least trying to form a bottom after this 10% correction for the metal stocks. I think the Nifty Metal Index, for example, was almost at 13,600, 700 mark start of the month of June, and right now they are almost at 12,500 mark. So it's almost like a 10% correction for the Nifty Metal Index. And in that context, you've seen so many metal stocks correcting by 20%. I think Vedanta has corrected by more than 20-25%. You've seen Hindalco down by 20% broadly. JSW Steel, Tata Steel sector, these stocks are down 10% from their recent swing highs. So the correction for many of these metal stocks is now getting into a bit of an extreme. We are also at a point, or rather one of the major reasons for that was dollar index moving up from 99 to 101 mark, where we've seen a substantial jump for this particular asset class, and that sort of impacted the metal stocks movement. So as of now, I would sense that the major part of the move would probably be governed by how the DXY or the dollar index moves up. We are still hovering around the 101 mark for the dollar index. However, price-wise, I think Hindalco, SAIL, Tata Steel, they could form to be attractive bets at the current juncture.
Devash, do you look at some of the metal packs and what do you say about Adani Enterprises? They raised a good amount of money through QIP recently. Do you look at Adani Enterprises?
No, so we had it under coverage, but it has gone beyond our target. So now it is no longer under our coverage. The metal as a space is interesting. I think as war was there, dollar was strengthening, and that put a pressure on all these commodities which are denominated in dollars. But as my fellow colleague mentioned, the correction is there, and now there is opportunity. I think these companies are likely to have pressure which were there because of the war. Margins were there under pressure. That will slightly move away, and they will start showing more cash flow. So in this correction, it is important that we allocate towards macro because next few quarters are going to give us good revenue visibility there also.
How do you look at the power pack, Devash? Do you look at Tata Power or some of the renewables as well?
Yeah, so we have renewables and power utilities, power generation and distribution companies under coverage. In fact, recently, after the correction, we have issued a report on utilities. Many companies like Adani Power, NHPC, NTPC, uh, Power Grid Corporation, Tata Power, all these are under our coverage and we see opportunity there. So recently, a report has been issued with all these as a long-term buy in our brokerage.
News coming in from the Tata Power AGM that Tata Power has outlined the growth roadmap at the annual general meeting. Chairman Natarajan Chandrasekaran said that the company plans to invest around 25,000 crores annually over the next 4 years. He also said the company aims to reach 1 lakh crore revenue by 2030. Listen in.
Towards this, the next 4 years, on an average, we will do 25,000 crores of capex. And though we allocate 25,000, depending upon the execution, it may be a little less. And we are able to catch up some of the projects, then it can be a little more. But between now and FY30, the total capital allocated is about 1 lakh crores. How will it be funded? Obviously, it will be funded in the form of debt and equity. We are comfortable to keep the debt between 3 to 3.5 times the size of EBITDA. That's our comfortable range. So anytime we need debt more than that, either the equity has to go up or we'll calibrate the execution. Most equity will come from internal accruals because we have about 16,000 crores of EBITDA now, which will keep going up. And I believe that whenever that is required, we'll definitely ask for rights issue. Currently, there is nothing in the plan. But at the right time, we may do rights issue or QIP if it is required. And that will not be a limiting factor.
Okay, that's N. Chandra highlighting the next 4-year capex for Tata Power as we speak right now. Having said that, the market focus, of course, has been a lot more on renewables. Devash, wanted to understand how is it that you're playing the entire renewable energy theme and where is it that you're finding investable value still, even after the up move that has already taken place?
So in fact, renewables have gone through a correction and we are waiting for a right entry point. We have these stocks earlier under coverage, but now recently we booked out of them and we are waiting for opportunity. In fact, in next few weeks to a month's time, when there is an appropriate entry point, I think the policy headwinds are over, the margin-related pressure should be over after this quarterly results. So we are waiting for an opportunity to enter into renewable space again. The regulatory issues which I'm sure we have been discussed. I think thinking of the past and going forward, they are available at an attractive opportunity now.
Devash, from an earnings point of view, we're seeing the earnings start from day after. How do you look at what kind of growth you're penciling in for the Nifty 50 in Q1?
So earlier, before the start of the year, the consensus our earnings were around 15%. That has been scaled down to around 12%. We expect that because there will be certain margin-related pressure because of the West Asia conflict, this quarter will be a little muted on the earnings growth compared to the earlier expectation. The sectors which are likely to do well, as I mentioned earlier, we continue to like BFSI in financial. Defense, selective defense companies are likely to give out good numbers, oil and gas, and select pharma companies. These are the ones which are likely to outperform. And as I mentioned, we are a little cautious on consumer side, consumer durables as well as the staples. We think that let's wait for monsoon to play out and then look at its impact on rural income before committing capital.
Kunal, index below 24,400 levels at this point in time. Do you think this weakness is primarily because of the expiry, or is it more to do with profit booking now because we have run up a bit in the last few weeks?
It looks more like expiry because I think it just happened the last half an hour at 3 p.m. is where the selling started for the indices. So it looks like that maybe it could be expiry adjusted. But if in case the markets are seeing some sort of a reversal or profit booking after this 3-4 days of a steady up move, then we could be in for maybe one more day of a price correction. So I think tomorrow's day could be quite crucial in that sense, because if we happen to see maybe another round of correction on the indices tomorrow, then there could be a possibility that we might probably come back into that midpoint of the trading range which we've been trading at. So we were earlier in the band of 23,850 and 24,150 200 mark, the midpoint being 24,000 levels. We've moved up that higher the range by another 350 points. So the fresh range for the index was 24,200 as a support and 24,500 as a resistance. So maybe I think we're just trying to come back to the lower end of this fresh trading range.
Okay, that's the take coming in on where Kunal sees the index headed, and of course, there is bound to be that expiry-led adjustment. Today, Biocon, Laurus Labs are the ones which are seeing a bit of a cool-off. Even Cipla is down about 1%. Kunal, any trend that you can draw out from pharma? Because up until last week, pharma was one of the leadership sectors.
It still is. In fact, after this price correction also, I think many of these pharma stocks have still done reasonably well. You look at, Sun Pharma, for example, the stock was almost at 1800 levels a few weeks back, and it's now jumped up to 1900 levels. Cipla, after the last week's price up move, prior to that the stock was at 1350. You're still at 1450 levels for the stock price. Same is the case with the other names like Dr. Reddy, DV Slab, etc. So I think as an overall pack, pharma still looks very attractive at the current juncture. What happens many a times is that when these stocks rally up by 8%, 10%, and these are pharma stocks which generally are considered to be low beta. So when they rally up 8-10%, you're bound to see a point where these stocks see some sort of a cool off, some profit booking, some moderation in terms of indicators. But once that moderation settles back into, is generally a better point to try and go for a contra buy into these names. So we'll wait for another couple of days for these pharma stocks to show signs of bottoming out, and then I think a better trading opportunity could arise.
Do you also see some kind of buying coming into some of the stocks like BPCL and HPCL, means OMCs today, because that's one pack which is up today?
So yeah, it's up, but there's still not major signs of price breakouts. We were discussing this earlier in the morning that many of these OMC stocks have been a huge underperformer from their Jan-Feb highs. They're down almost 30%. From those 3-month, 6-month highs for themselves. And in the scope of this recovery, when crude oil prices have ebbed off from 108, 110 to now $70 per barrel mark, we're looking at these OMC stocks which have recovered just about 5%, 7% from their recent swing lows. So for these stocks to make a comeback, they need to see strong evidence of a breakout. For example, for IOC, the breakout level is around 150 mark. The stock has been struggling to break past about those levels for the past 1 to 2 months. So we need to see those evidences of breakouts happening into these names. That's where I would believe that a stronger degree of momentum could arise or a trend could start off. Otherwise, these could just be fragmented moves for these stocks.
Devash, how is it that you are playing out their entire crude cool-off theme, and whether any of the crude sensitives would at least make for a tactical move?
Yes, so around mid-April, we came out with a theme which is bounce back, and there we chose, assuming that the worst for the crude oil was over, we came out with a list of 10 stocks to play out on this theme. There we chose not only direct beneficiaries, rather than we chose the stocks which were actually impacted because of the higher crude oil prices. Case in point were autos like Maruti and others. We chose Asian Paint and Ultratech Cement, Indigo. So these were the ones which were directly impacted, and that portfolio, that basket has done really well, given good about 30% or so alpha compared to market. So these themes which we have been playing from April, I think that continues. Crude oil, since what has happened in Saudi Arabia and other OPEC plus, there is room that still it can correct another $10 or so over the next few months, and that would be appropriate time to book out of these these themes if you have invested in the recent fall.
Right. Okay, Devash, great to have you today on the show. Kunal, we'll let you go on that note as well. Let's begin.